Hi everyone, I'm Siraj Fidai. I'm a tax specialist who spends a lot of time at the intersection of benefits for families with health issues as well family law, employment income, and CRA rules and most updated information about understanding your tax return and dealing with CRA in details line by line. In this particular podcast, today we are discussing about tax strategies. Okay, let's dive right in. For a lot of us, tax time feels well. It feels like a chore, right? Unnecessary evil. But what if we flip that on its head? What if we started seeing it as one of the single biggest opportunities all year to strategically keep more of our own hard earned money? Well, that's exactly what we're going to do right now. You know that feeling, that nagging fear that you might be overpaying the tax man? It's a real thing. Every single year, tons of Canadians miss out on key deductions, or they make these simple little errors that cost them thousands. The good news? Understanding the rules is the absolute best way to make sure you're not one of them. So here's our game plan. We're going to kick things off with a super common trap for anyone in the service industry. Then we'll pivot to a crucial strategy for retirees. After that, we'll cover a dangerous pitfall for homeowners, a seriously powerful timing strategy for your RRSP, and we'll wrap up with some must know rules for families. I promise by the end of this, you'll be looking at your tax return in a completely new light. First up, a topic that causes a massive amount of confusion: tips. If you work in the service industry as a server, a stylist, a bartender, getting this right is absolutely critical. So let's break it down. Now, what you might not know is that the Canada Revenue Agency, the CRA, well, they have expectations. They actually use these industry benchmarks to get a feel for whether your reported tip income seems reasonable. So think about it. If you're a server and you report, say, 5% in tips when the CRA is expecting something way closer to 13, maybe even 20%, that could totally raise a red flag for an audit. So listen up, because this is the number one mistake people make. You got control tips. That's the stuff your employer manages and puts right on your T4 slip. Then you've got direct tips, the cash that goes straight into your pocket. The key is you only need to report your direct cash tips on top of what's already on your T. For the huge mistake is adding the T4 amount again when you report your direct tips. You end up reporting the same income twice and paying way more tax. Okay, now let's shift gears. We're moving from earning income to managing in retirement. For higher income seniors, there's this major hurdle called the old age security recovery tax. You've probably heard it called the clawback. This number right here, this is the key. Every year, the government sets an income threshold. And right now, it's sitting around $95,000. If your personal net income goes above this line, the government starts taking back or clawing back a piece of your OAS pension. But here's the thing: there's a brilliant and totally legal way around this. And this slide shows that strategy perfectly. It's called pension splitting. Just look at this example before spouse A is way over the threshold and is getting hit with that clawback. But by splitting up to 50% of their eligible pension income with spouse B, look what happens. They bring their own income right down to the threshold. The family's total income is exactly the same, but they've completely sidestepped the OAS recovery tax. It's fantastic. And this isn't just some vague idea, it's a real actionable strategy. The tool you need is Form T1032. It has to be filled out, signed by both spouses, and filed. It's a simple piece of paper that can literally save a retired couple thousands of dollars every single year. All right, let's talk about assets, specifically your home. If you rent out a piece of your house, like a basement apartment, there is one deduction you need to be and I mean extremely careful with. This deduction is called the capital cost allowance, or CCA. And on the surface, it makes total sense. You're a landlord, so you should be able to deduct the depreciation on the rental part of your property.
Right.
It seems like such an easy way to lower your rental income and save a bit on tax. Wrong, and this is a big one. The professional guidance on this is crystal clear. Never ever claim CA on your main home. The tiny bit of tax you might save is nothing. I mean, nothing compared to the catastrophic tax bill it can create later on. So here's why it's so dangerous. You know how when you sell your main home, the profit is usually tax free? Well, claiming CA on a part of it basically tells the CRA that you've changed its use from a home to a business asset. And that means when you sell, that part of the profit is no longer tax free. You could be staring down a massive capital gains tax bill, all because you wanted to save few $100 a year on deduction stock. It is just not worth the risk. Okay. Now, for one of my absolute favorite strategies. Why? Because it proves that smart tax planning is about more than just what you claim it's about. When you claim it, this is some next level thinking for your RRSP. So, we all know that putting money into an RRSP, a registered retirement savings plan, gets you a tax deduction. But here's the kicker that most people don't realize: you don't have to claim that deduction in the same year you make the contribution. You can put the money in this year, but save the deduction for a future year. Now, why on earth would you do that? Here's the play by play. Step one, you make your RRSP contribution this year. Step two, you know that next year you're getting a big raise or a bonus that's going to push you into a higher tax bracket. So, step three, you wait and you claim that deduction in that higher income year. You use it to offset income that would have been taxed at a much higher rate, which means a much, much bigger tax refund. It's all about strategic timing. Okay, so far we've covered earning, retiring, and investing. To round things out, let's hit on a few high impact rules that are just crucial for families to know. These aren't hidden loopholes, they're just key details that can make a huge difference. This one gets mixed up all the time. So let's set the record straight. Spousal support, you might call it alimony, is deductible for the person who pays it, and it's taxable income for the person who gets it. Child support, on the other hand, is totally different. It is never ever deductible for the payer, and it's not taxable for the recipient. The CRA is incredibly strict about this distinction. Here's another strict rule:
This one's about childcare.
the deduction for things like daycare or a nanny has to be claimed by the spouse with the lower net income. There are very few ways around this. Now, here's the weird part. Even if that spouse had lower income and no tax payable, you still have to report it on their return. It seems pointless, but it's not. That's because reporting that expense can actually trigger or increase other provincial benefits like the Ontario Trillium benefit. So, no tax payable, filing this correctly can still result in a check from the government. So, when you pull it all together, what's the big takeaway? It's that smart tax planning isn't about finding some shady loophole or trying to pull a fast one on the system. It's about truly understanding the rules of the game and then using them to make strategic choices that are best for you and your financial situation. From how you report tips all the way to how you plan for retirement. And that really leaves us with one final thought to chew on. Instead of just seeing your tax return as a boring summary of what happened last year, how can you start using it as a forward looking tool, a strategic roadmap that helps you plan your investments, your retirement, and your family's financial future way more effectively? Now, that's a powerful shift in mindset. We hope you enjoyed this Tax Strategies podcast. Would you please click the like and subscribe button so you receive future releases and for the podcast to your friends, family, and colleagues. This presentation is for the audience general information only. Please consult your accountant for professional advice. You can visit our websites ifmsolutions.com and disabilityrefunds.com. At IFM Solutions, you will find out about our accounting, bookkeeping, payroll, and advisory services. Our disability refunds website has a treasure of information for people with health issues and their family members, especially those wishing to apply for disability tax credit and CPP disability. For any comments, suggestions, or to contact us, please reach out at 1-855-786-4786 or email us at info@ifmsolutions.com. Thank you. See you next time. Bye and take care when filing those lines.
You are watching IFM Solutions podcast. The Tax Strategies.